Program is brought to you by realestate.com.au, Australia's #1 address in property. With more properties for sale than anywhere else, we make it easier.
Thanks for being with us here on Business Now. Around the country, there was a slowdown in auction clearance results, and that perhaps shows the concern about rising interest rates and cooling home values, and eventually they're catching up with what had been white-hot housing markets around the country. Angus Moore is an economist with REA Group who joins me now. Angus, thanks for your time. I mean, let's be honest, this is just basic economics 101. If interest rates go up, asset prices come down. At least that starts to be the signal. The interest in buying is starting to cool off.
Thank you for having me, Ross. Great to be here again. We're certainly seeing that the effect of higher interest rates flowing through to the housing prices and to housing markets more broadly. So we saw prices fall last month for the first time nationally since the pandemic began. And I think that's really kind of presaging things to come. We'll probably continue to see prices fall at least for the next few months and potentially into next year, given how quickly and how abruptly the RBA is raising interest rates.
But one really interesting part about this, I know a lot of young people sometimes bemoan the fact I can't get into the housing market, it's tough, all that sort of stuff. It's periods such as this when housing prices are falling, that if you're very confident in your job and your future income stream, that's your moment to actually try and get into the market, knowing eventually that if interest rates do come down, that the opposite effect starts to happen as well.
Right, and we saw that through the pandemic, right?
Yeah.
Big driver of surging house prices through the pandemic. I mean, they're up 35% across those couple of years, was falling interest rates. And so, that's going to start to work in reverse now, but equally could work the other way if you buy now, make it through the next period of rising interest rates and benefit from the next cutting cycle. So
there's an interesting point you make, is that housing values rose 35% during the late pandemic, which is 18 months really, let's be honest.
Yep.
And so then even if they come off 2, 3, 4, 5, 10%, they're still well ahead of where they were pre the pandemic. That's the point that people have also got to understand.
Yeah, it's a really important point, and it's one that sometimes gets a bit lost. Not that many people have bought recently. Housing turnover in a year is something like 1 in 20 houses. So most buyers bought more recently than the past 12 months, meaning they're sitting on as much as 20% price increases, or even more if they bought more than 12 months ago. So many are actually in really good, strong positions.
And the real issue is for those who bought more recently, it's them now having to hang on, because if they become forced sellers, that's where the issue of negative equity comes into it. That's when banks start to have problems because they have bad and doubtful debts rising. So right now it's a situation of that jobs market, which is very, very strong right now, that you hope that recent buyers are able to hang on to their employment.
Yes, certainly the jobs market is absolutely fundamental for mortgage arrears and mortgage defaults. The biggest predictor of mortgage default is losing your job. Unemployment remains incredibly low, it's 3.9%, lowest in many decades. And so that's going to help keep people in their mortgages. We're also starting to see signs that wages growth is picking up. It's not strong, and we're not seeing it picking up quickly in the official data, but there are signs it's starting to happen. That will also help people service their mortgage and start to offset even as interest rates rise, potentially quite quickly over the remainder of this year.
Just a brief one for you. Would you like to be a property developer right now who's a crane on top of an unfinished building, a residential building right now?
Look, I wouldn't, simply because of what's happening with construction costs at the moment. It's a pretty tough market for construction builders at the moment. Construction costs rose for new homes 15% over the past 12 months, and many of those are on fixed price contracts, which squeezes your margin out a lot. Obviously, for developers, that puts your builder at risk, and that puts your project at risk. So I think for some developers, it would be a bit of a tricky time at the moment.
Bit of a tricky time, I think, is an understatement. Angus Moore, as always, thank you for your time on the program today.
Absolute pleasure. Thanks for having me.